Hello and welcome to the latest quarterly market update from Astute Investment Management. I am Jessica Creasey, Communications Assistant here at Astute Private Wealth, joined by our Chief Investment Officer, Dr. Scott Osborne. So Scott, let's start in the UK. We have very recently had a new Prime Minister in the form of Andy Burnham, our 5th in 5 years. It's still early days, but how do you see this changing the outlook for us in the UK?
Yeah, okay. I mean, 5 in 5 years isn't a great look. It's the first thing to say, isn't it? But what will actually change from here? From our perspective, we don't think this, as much as it is a new Prime Minister and, Healy in the Treasury and all this, there's just not that much room for manoeuvre for anybody, whoever it was, to do anything. So we don't see there being a huge amount of change, is the sort of headlines to it. Now, within that, there is a lot of nuance and there is a lot of space for different things to happen. Obviously, they've already announced the budget date for this October, so 28. There's not a long run-in time between now and then for them to really, do big reform. If they wanted to tackle some of the big issues that apparently are important to Andy Burnham, like a land value tax or get to grips with stamp duty and business rates and so on. So in the short term, probably you'll see more of what we've had so far, which is a bit of this breathing space, a few giveaways that don't really amount to much, and try and just work on the sort of positive feeling that Starmer and his government weren't very good at. From a market's perspective, what really matters to us is just how much they're going to borrow. And whilst they've talked build on credibility and the fiscal rules and so on and so forth, there's a lot of kind of massaging and hiding of numbers you can do. Fundamentally, from a markets participant like me, the government is going to have to issue a certain amount of debt, and that means they're going to have people buy that debt. And if they're going to issue more debt than people are willing to buy, then yields are going to rise, and the government will have to pay more to borrow that money. That's the basic black and white of supply and demand, and government debt's no different. So whatever they do, whether they sell a good story or not, they are going to be tied to that framework. And essentially that means that if they want to do anything big, they're either going to have to raise taxes or cut spending, or probably both, in order to generate the room to do it. And that's it really. And to be honest, even if you sort of Liz Truss the scenario and didn't make a real pig's ear of it, Liz Truss didn't stay around for very long because she got that wrong. She was out the door and someone else came in. So I don't really worry about those downside scenarios anymore, because the market fixed that pretty quickly. And then in terms of the upside, I think there is genuinely an opportunity for him to sort of change the narrative and shift things and just get a bit more of a positive vibe around the country, because that's really where Starmer failed massively. Given how the election and how successful he was, it's been pretty negative since day one. And really that's what the UK economy needs, is the shift in sentiment, and anything that they can do to generate that would potentially unlock a reasonable amount of upside for the UK economy, which at the moment is doing okay. It's not terrible, but it could be better. So that's it for us. I don't really. The downside, if there was one, it would probably be quite quick and then be over with, and you'd have another clean broom. The upside is the sentiment shift, but how do they achieve that? How do we do it? In the grand scheme of things, we've not really worried about it that much at all, to be honest.
Okay, Scott, so we've spoken in previous videos about a potential bubble in AI stocks and the massive investment boom led by US tech companies. Can you update us on any recent developments in this area and your thoughts on the broader AI story?
I mean, this is a huge theme. We haven't talked about it for probably since the end of last year, but it's been bubbling away in markets the whole time. I think the developments we've seen over this year really is a couple of things. One, on the actual big tech names themselves, so the hyperscalers like Google and Microsoft and so on, their spending has continued, like massive amounts of capex and infrastructure sort of build out. The market has not rewarded them for that so much as it did in the past, because the market is starting to worry a little bit about the return on that investment. The amount of cash that's going out the door, they're not seeing a lot of cash back in because of that yet. But that's against the backdrop of still incredible earnings. Like, these companies are still making tons and tons of money, mostly from cloud, so there's sort of cloud computing stuff. But a few early warning signs there as well, in that some of this earnings, that sort of expected earnings, is a bit circular, and if you buy my chips, like if you're NVIDIA, and then I'll put them in my data centers and I'll make money on the cloud and you make money on the chips, and it all looks a bit sort of like a circular operation, is a bit worrying. And like I said, the market's onto that. So those companies themselves haven't necessarily done as well as what they did recently. Outside of that though, that big spend is finding its way out into the global economy, and that's where you've seen the big moves probably this year and the end of last year, particularly emerging markets, names like Samsung and SK Hynix, who you may or may not know, but these are big like memory chip makers, and they can charge any price they want at the moment for their memory because there's such demand for it to go into data centers. So their earnings have gone through the roof as well. And then big companies like TSMC, so that's Taiwan Semiconductor Manufacturing, where they're basically the global monopoly on high-end chips. Those companies' earnings have gone through the roof. And actually the irony of this whole sort of phase is that these companies have actually got cheaper over this period because the earnings expectations, the amount of money they expect to make, has gone up much more even than the share price has. So they're technically cheaper than they were, but people are a little bit more worried about their earnings in the future. And those two names that I mentioned in EM are a very good example of that. So Samsung and SK Hynix, because they're basically charging through the nose for memory, which in the past has been pretty much like a commodity. You know, it's a supply and demand dynamic. There's no real moat or defensible. If there's more demand, then it will just be made, and eventually it kind of evens out. You can't necessarily increase your prices indefinitely. And at the moment, the market is kind of expecting that actually these prices could just keep going up and up and up, and the companies would keep making more and more money. And that's what's drove the stock prices up year to date. But in reality, that probably can't last forever, in the same way that the data center build out can't last forever. And so you get in this kind of short-term, long-term conflict. And that's where we've got to be a bit careful as investors to not get caught up in the kind of bubble-like behavior where you focus on these very short-term potential and lose sight of the long-term. So we have made a couple of tweaks around that, but yeah, you know, but stepping back, it's still ongoing. There is still this big build out. You know, we are seeing some influence of AI maybe in productivity numbers and things like that, but at the moment it's still a bit more. There's more cash going out the door than there is coming in, and that's why there's been a bit of a caution around some of the big names in this space. But it remains a watching brief for us, and like I say, we're just trying to avoid some of the sort of more worrying areas of where maybe it gets a bit speculative or exuberant a bit too much, and that's basically the job that we've had in this space.
Okay, so looking ahead, markets are often quieter over the summer months. What things are you and your team going to be looking out for over the next few months?
Yeah, so I mean, August is always a quiet month, and there's no central bank meetings or anything. So I suppose that's the first thing to say. By the next time we sit down, the US midterms will have just happened. So obviously we've got to watch out for that. I mean, expectations at the moment is that the Democrats will take the House, but not the Senate. Just because the Senate map is quite difficult for the Democrats, and even if they hold on to sort of Michigan and Georgia, they've still got to flip a couple of what are essentially red states: Texas, Iowa, Ohio, and Maine. Probably got to get two of those, and North Carolina. So that's not too easy. So, but you know that the rhetoric around that will start ramping up pretty soon. So keep an eye out for that. We've got interest rate decisions in September, which will be a big one because the central banks in the last round of meetings could basically not do anything and hold rates because they had August to ruminate and think about things, see how things happen in Iran. So there'll be big interest rate decisions in September coming. Probably the Bank of England hold again, although that's not certain. The feeling there was that they don't really want to have to hike rates, and so there has to be some sort of data point that will push them over the edge. Maybe a little bit more balanced in the US where they might have to hike unless they can find a reason not to. And that's it really. Yeah, those are the big things. Obviously, there's a constant watch on Iran and what happens there. And the talk today is that there's a ceasefire again, and maybe tomorrow it changes. But we really do need some resolution to that for everything to sort of coast on a nice path. But they're the main points to look out for. But on the next time, US politics, interest rate decisions. Obviously, we've already mentioned the budget. But there's always something. There's always something to keep us busy.
So to bring this all back to the Astute funds, given the volatility over the last 3 months, have the views of the team changed at all, and have you made any changes across the portfolio as a result of this? Yes,
I mean obviously we've talked about quite a few things there, and in previous commentaries as well. I think the main thing to say that we've done over the course of the sort of last 3 months is that we have once again trimmed risk a little bit. So we entered the year probably neutral on risk assets. We're probably very slightly underweight equities at this point. Now we have balanced that off. The main move that we did there was to reduce our emerging market equity exposure. This is an area that we've liked for a long time. It's actually done really well. But what we're seeing at the index level is that bubble risk that I talked about earlier really materializing. And actually because those three names I mentioned actually, so TSMC, SK Hynix, and Samsung have done so well, the combined sort of weight of those three stocks in an emerging market index was close to 30% or even over 30%. So we just did not like that concentration risk given what I said about short-term expectations on earnings and so forth. So we sold our passive exposure in EM because we didn't just want to blindly accept that index concentration. And we reduced our overall weight slightly because just concerns around that concentration over time and the effects it could have in those markets. So that's the main thing. But rather than just take risk off the table, because again, we're still reasonably optimistic about things, although with this sort of valuation issues and so on and so forth, the underlying economy still looks okay. So what we did do was buy riskier bonds in emerging markets. So we've put some of that emerging market equity back to work in emerging market debt. So we still like that space, we still like emerging countries, we still like the growth opportunities there. We just didn't like the specific risks around certain valuations in emerging equities. So we've put in a new fund, a PIMCO Emerging Market Debt Fund, across the board. So whilst we're kind of underweight equities now and we've reduced our risk, we have increased the risk that we're taking in our fixed income portfolio to try and offset that. And really that's the game for us over this kind of period, because we can see the markets can still run on and there can still be a really long, if it is an AI bubble, it can still keep inflating for a long time, and you don't just want to completely withdraw from risk markets, but it's finding the smart ways to take that risk on in this environment and delivering good risk adjusted returns rather than sort of chasing the market higher. And so that's a good example of one of those trades where we're saying, okay, we don't like the risk here, we don't necessarily want to reduce risk in the aggregate. Let's reduce the specific risk around this that we're seeing and find a decent replacement or another way to play the same kind of story. And that's exactly what we've done by sort of swapping equities for bonds. So that's been the main story over the last 3 months. Again, all this stuff I've said in previous videos, we still think there's a great opportunity in fixed income at this stage. Government borrowing costs are higher for various reasons, but that's great for investors. You can get paid 5% to lend to the UK government, which is a rate above inflation. All those long-term opportunities are still there, and really it's just trying to focus on that long-term sort of delivery of financial plans for our investors, not getting caught up in some of this exuberance in short-term and thematics and so on and so forth. So that's it really. We'll stick to our knitting, we'll keep trying to think that way, make sure that we're aligned with what our investors want, and that should lead us in the right places and making good decisions.
Thanks, Scott. A really interesting update as always. That's all we've got time for today. So if you have any questions following this video and you are already a client of Astute, please get in touch with your normal financial planner. If you are new to us, we have left a link in the description box below that will guide you to the right place. Thanks for watching, and we'll see you next time.